In the last session, we explored the governance and culture that underpin effective liquidity risk management, emphasizing that processes and systems must be matched by clarity, responsibility, and risk-aware behaviors. Now we turn to another essential relationship in the banking system, the one between liquidity and capital. Now, these two concepts, distinct but deeply connected, form the twin pillars of financial resilience. In this session, we'll explore how liquidity and capital interact, how they differ in purpose and behaviour, and how banks manage them together as part of an integrated balance sheet strategy. We'll also look at regulatory expectations, capital liquidity trade-offs, and the lessons learnt from past crises. By the end of this session, you'll understand why liquidity and capital are not just separate risk categories, but two sides of the same resilience coin. So let's begin in defining the difference. Capital is the cushion that protects a bank from insolvency. It absorbs losses when asset values fall or when the bank's business model underperforms. It reflects the bank's ability to remain solvent, meet regulatory thresholds, and continue operating as a going concern. Liquidity, on the other hand, is about survival, specifically the bank's ability to meet its cash obligations as they fall due in the short term. It's not about losses, it's about flows. A bank can be well capitalised and still fail if it runs out of liquidity. Now, likewise, a bank can be liquid in the short term, but fundamentally undercapitalised, leading to an eventual solvency crisis. Now, this distinction is critical, especially in stress events. Consider what happened during the global financial crisis. Some banks that appeared strong on capital, thanks to large equity cushions or retained earnings, still collapsed or required emergency support because they couldn't access short-term funding. Their assets were illiquid, their counterparties pulled away, and their buffers were either unusable or insufficient. Liquidity crises often unfold faster than capital crises. They can emerge in hours or days rather than months or years. But while capital and liquidity are different in purpose, they are deeply connected in practice. One of the most important connections is confidence. Market participants and depositors care about both liquidity and solvency. If a bank is seen as undercapitalised, it may suffer a liquidity run as counterparties withdraw funding or clients move deposits. Conversely, if a bank is seen as illiquid, it may be assumed to be in trouble, prompting credit downgrades or equity sell-offs that erode capital. Now, this is known as the feedback loop between capital and liquidity, and it can be both rapid and reinforcing. This is why regulators require banks to manage both dimensions together. Under the Basel III framework, banks must maintain a minimum common equity Tier 1 capital ratio to absorb losses, as well as meet LCR and NSFR thresholds to ensure liquidity resilience. In the UK, the PRA also expects banks to assess both capital and liquidity adequacy through ICAP, which is the Internal Capital Adequacy Assessment Process, and ILAP, the Internal Liquidity Adequacy Assessment Process. Now, these assessments are reviewed jointly by supervisors during the Supervisory Review and Evaluation Process, SREP. Now, in practice, ICAP and ILAP must be aligned. That means the assumptions used in capital planning, such as revenue forecasts, loan losses, or market stress scenarios, must be consistent with those used in liquidity planning. For example, if the ICAP assumes a 20% drop in mortgage valuations, the ILAP must consider how that might affect the liquidity value of mortgage-backed securities. If the ICAP includes a severe earnings shock, the ILAP must consider the knock-on effects on funding access or buffer usability. Banks must also consider capital liquidity trade-offs. For instance, holding more capital can improve market confidence and reduce funding costs, enhancing liquidity indirectly. But raising capital can also be expensive or dilutive, especially in times of stress. Similarly, increasing the liquidity buffer improves short-term survival, but often at the expense of profitability, as high-quality liquid assets typically yield less than loans or securities. Now, Treasury and finance teams must balance these considerations when planning the balance sheet, managing investor relations, and allocating internal resources. Funds transfer pricing plays a key role here, as we discussed in earlier sessions. FTP allocates both liquidity and capital costs to business units, helping to ensure that lending, deposit taking, and trading activities reflect their true economic impact. A loan with high capital requirements but low liquidity risk will have a different FTP than one with the opposite profile. Now, this pricing helps business units optimize product design, client selection, and growth strategies in line with risk appetite. Another connection between capital and liquidity is in stress testing. Banks must run integrated stress scenarios that show how capital and liquidity positions evolve together. For example, a downturn scenario might reduce income, increase credit losses, and cause capital ratios to fall. At the same time, funding markets may tighten, LCR may decline, and the survival horizon may shorten. Banks must demonstrate that they can survive these combined stresses without breaching thresholds or needing extra support. Integrated stress testing is increasingly expected by regulators. In the UK, the PRA reviews stress tests as part of the SREP and expects consistency between ICAP and ILAP. In the EU, the ECB's liquidity stress testing guidelines also call for alignment with capital scenarios. Some banks have begun using consolidated dashboards that show both capital and liquidity under various scenarios, providing ALCO and the board with a holistic view of resilience. Now, recovery and resolution planning also brings capital and liquidity together. A good recovery plan identifies options for restoring both capital and liquidity, such as selling assets, issuing equity, or reducing risk-weighted assets. These options must be assessed for feasibility, timing, and effectiveness under stress. For example, selling a business line may improve capital but worsen liquidity if it triggers outflows or requires cash upfront. Similarly, issuing debt may improve liquidity metrics but raise capital costs if spreads widen. Resolution planning, particularly for global systemic banks, requires careful coordination of capital and liquidity resources. Regulators assess whether the group can be resolved in an orderly way without taxpayer support. Now, this includes ensuring that enough loss-absorbing capacity, or TLAC for short, is available to recapitalize entities and that sufficient pre-position liquidity exists to support critical operations. The Bank of England's Resolvability Assessment Framework, known as RAF, and the ECB's Banking Union Resolution Planning both emphasise the need for alignment across capital and liquidity pillars. One area where capital and liquidity intersect closely is in contingency funding actions. For example, in a stress scenario, a bank may plan to raise capital to restore confidence, but doing so may signal weakness, triggering liquidity outflows. Or the bank may plan to draw on a central bank facility, improving liquidity, but possibly promoting a ratings downgrade that affects capital markets access. Now, these interdependencies must be carefully modelled, sequenced, and communicated. From an investor perspective, capital and liquidity are often viewed together. Credit rating agencies assess both when assigning ratings. Equity analysts consider both when valuing banks. Bond investors look at both to assess creditworthiness. For this reason, banks must manage external communication around capital and liquidity in a coordinated way, ensuring consistency, transparency, and credibility. Internally, the Treasury, finance, and risk functions must work together to coordinate capital and liquidity planning. Treasury manages funding and liquidity buffers. Finance models earnings, dividends, and capital forecasts. Risk oversees stress testing, capital models, and liquidity frameworks. These teams must share data, align assumptions, and co-own decisions. In many banks, this coordination is achieved through joint planning forums, shared systems, and cross-functional teams. Now, technology plays a growing role here. Leading firms are building integrated balance sheet management platforms where capital, liquidity, and interest rate risk are modelled together. These systems allow banks to simulate strategic decisions, such as asset growth, capital issuance, or buffer optimization, and assess their impact on all key metrics. This supports better decisions, faster responses, and more effective communication with regulators and investors. It's also worth noting that capital and liquidity planning must consider longer-term risks, including climate risk, geopolitical shocks, and digital disruption. These risks may affect both solvency and funding through changes in asset values, income volatility, or investor sentiment. Scenario planning and strategic foresight are becoming essential tools in connecting the capital liquidity landscape to future uncertainty. To summarize, liquidity and capital are different but interdependent. One protects against insolvency, the other against illiquidity. Both are essential to survival and both must be managed collectively. Banks that take an integrated approach, aligning plans, coordinating teams, and connecting assumptions, are better equipped to weather stress, meet regulatory expectations, and sustain long-term success. In our next session, we'll explore how liquidity risk management interacts with climate risk and ESG. We'll examine how environmental trends and sustainability objectives are reshaping funding models, investor expectations, and regulatory frameworks. I'll see you in the next session.